topic that we'll be dealing with today is called income taxes. Dealing with income taxes. Um, it's it's easy, it's difficult, you know, depending on your on how we're going to understand this. When I'm saying understanding, I'm saying that there are two things that we need to incorporate when we're doing income taxes. There is the accounting side of things that you did in FAC 2601, you know. Then there is the taxation side of it that you did in tax 2601, you know, or tax 3701 or whatever it is, or we are doing in tax 3761, you know. So we need to incorporate the two in trying to understand to get where we want to go. Because your mind at some point needs to say, okay, this is accounting. This is how this is treated in accounting, right? Then we shift a bit and say, this is how this is treated in taxation, right? So we have a one guy that is standing on the accounting side, then we have another guy that is standing on the taxation side. Then these two guys are discussing to say, how do we deal with this? Okay, you have done this and I'm supposed to do this, but no, here I'm not allowed to do this. How do I deal with it if I'm not allowed to do it? Because remember, the guy that is standing in accounting is saying that, okay, the financial reporting standards allows me to do this so that I can present my financial statements. Then there is a guy that is in taxation who says that, no, the Income Tax Act allows me to do this and does not allow me to do this. So if we have these differences, how do we deal with these differences that we have? Who's going to prevail at the end? So we need to sit down and say, the person who's going to prevail at the end comes back from the objective to say, what is the aim of doing what we are doing so that we know who's going to stand at the end of the day. So in this time, we are saying that we're dealing with income taxes. So in other words, who's going to stand at the end is the side that is on the taxation side. So whatever you are, your understanding in the accounting side, yes, we understand this is your accounting. So if we need to reverse the accounting side, let's reverse it so that the taxation side can prevail. Because right now we need to understand, okay, how do we calculate the what? The taxation. Um okay, it's not a setting, ne? To allow more than 100 people. It's a subscription that I need to do. I think I'll do it after the class. It's a subscription that I need to do to allow more than 100 people. I noticed that um I noticed that ne, I'll sort it out for the next class. It will be sorted out. Kelezo, no, it will be sorted out. Okay, so just sorry for the disturbance. I think let me start writing now. All right, we were talking about income tax. Talking about income tax. Just hold on. All right. Okay. I'm back. I'm back. All right. I was saying we are dealing with income taxes. So our income taxes, we are saying that we are incorporating two guys, right? I'm going to call the other guy business, and I'm going to call the other guy sales, right? Okay. So now at the business here, there is an accountant. Then there is EFRES standards. Then here on SARS, there is Income Tax Act. Right. Then on the business, there is profit for the year. Or rather, let's call it profit before tax. But here in there is taxable income. But to get to profit for the year, to get to taxable income, there are two things that are involved to get there. To get to profit for the year, it's income minus expenses. For us to calculate profit for the year, we get income, revenue, cost of sales, gross profit, other income, expenses, you get profit. But for us to get to taxable income, it's gross income minus expenditure. So the gross income as per the definition, section 11, general deduction formula. So here we are saying that we are allowed to include this income, to subtract these expenses per the Income Tax Act. Then this guy is saying that, no, I'm allowed to include this income and expenses per the International Financial Reporting Standards. Then there is a time where we don't agree and we differ. This is the time where we are now engaging you. So if we have 50,000 income, 50,000, 20,000 expenses, and accounting says 50,000 income minus 20,000 expenses, you get 30,000 your profit. Then income check says 50,000 is gross income, 20,000 is deductions. You have 30,000. It means that in this case we are agreeing. There's no, our income are agreeing, our expenses are agreeing, so we can simply calculate our tax times 27%. We get our tax that we're supposed to pay. So there's no misunderstanding, if I can use this word. Allow me to use that word. But we are agreeing on the income, and we are agreeing on the what? We are agreeing on the expenses. Yes, it's profit before tax, actually, yes. So now our income tax includes three things. Our income tax includes three things. We have the current tax, the one we say taxable income times 27% or times 28%, depending on which year. We get our current tax, income minus the expenditure that were incurred, actually incurred. We get what? We get our current tax plus deferred tax plus foreign tax. It's current tax plus deferred tax plus foreign tax. So we'll be looking at each. We're going to start with our current tax. Then we're going to go to our deferred tax. And then we're going to go lastly to the foreign tax. All right. So current tax. Let's just give a background before we start. All right. What basically are we saying? What is it that we are saying? We are saying that when a business is operating, right? When a business is operating, at the end of its financial year, it needs to produce its tax returns. when it produces its tax returns, it needs to account to SARS on how much tax it's supposed to pay. And this tax is calculated at the rate of 27%, right? Right now it's 27%. You guys can unmute yourself right here. Yes. It's 27%. Previous years it was 28% until COVID years. Right. So we are now saying that at the end of each year, a business is supposed to pay tax to SARS. But how are we going to calculate that tax from the accounting perspective is what we're going to be doing today. If we just have tax, they say, you know what, here are your receipts and here are the invoices, calculate tax. It's easy for us because we simply go to the text and we'll be looking at each invoice to say, okay, is this included? Yes, let's include it. Is this not included? Yes, it's exempt. Let's remove it. Is this included? Then at the end, we say times 27%. Then we know that the tax that we're supposed to pay. But we are saying that after preparing the financial statements, using the standards, we now want to calculate how much tax are we supposed to pay. After calculating the profit with the what? With the standards. If we have not calculated the profit with the standards, then we are fine. But after we've already calculated the profit, this is where we now say, okay, this is the profit that we have, but how much is the tax that we're supposed to pay? How much is the tax that we're supposed to pay? So in other words, we are standing on the profit before tax. We are now standing on the profit before tax. We have said revenue minus cost of sales, other income, other expenses, then we get our profit before tax. Then there we write below income tax expense. Then we say now, let's go and calculate the income tax expense. That's now position where we are standing. Guys, do we understand that position? Because this position is very, very important. Why? Because it's going to tell us where we need to add and where we need to subtract. So in other words, when we say revenue and we say cost of sales, then we get our gross profit. Then we say other income. We include our other income, dividends, whatever. Then we say other expenses. Then we include all the expenses. Then we say profit before tax. Then we say, okay, here's our profit before tax. Then below we say income tax expense. So this is where we are. This is where we are now to say, yes, I've calculated my profit before tax. Now, let's go on a separate page and I calculate my income tax expense. Then I come back and I put it here. Then I say, here's the profit for the year. But what are we going to do now? Since we are already in accounting, this is what we are doing. So we are saying that our income tax expense that we're going to calculate here includes the current tax, the deferred tax, as well as the what? As well as the foreign tax. All right. So for our calculation of our current tax, we are saying that this is tax calculated on the taxable income at the rate of 27%, right? So this is what? Tax on taxable income at a rate of what? This year is 27%, right? I'm sure it's 27%. Sure it's 27%. Since they reduced it during COVID, it has not yet went up. Can you guys unmute yourselves? I'm just oh,
Yes.
Yes.
No, we're paying
All right.
attention.
All right. No problem. Thank you. I was just making sure in case maybe you're trying to unmute yourself and you can't. All right. So then talk of deferred tax. Okay. Deferred tax, this is tax that is calculated on temporary difference. Temporal differences. Again, at 27%. So We are saying, guys, there is a guy that is in accounting. Then there is a guy that is in taxation. These guys, they differ in some things on how they treat their expenditure. When we say expenses and then they say expenditure actually incurred, they differ somehow and their rates, and so this creates a temporal difference. And that creates deferred tax. When we go to deferred tax, I'll explain in deeper on the temporal difference and what gives rise to the temporal difference and why do we call it deferred tax? Because it's tax that we're going to pay or recover in the future, right? That's why we say deferred tax. So we'll be also looking at it. Then we have foreign tax. This is tax calculated on foreign income. In most cases, it's given. So we won't be looking much on it. Won't be looking much on it because we are now saying that you have you are now saying that you have invested in the United Kingdom, right? And when you have invested in the United Kingdom, the company that is United Kingdom is now giving out dividends. But we know that dividends, they have an withholding tax. So before they transfer these dividends to South Africa, they also withhold the dividend tax and paid the tax in the United Kingdom. So now these dividends, they're coming probably to South Africa net of what? Net of tax. So this is now foreign what? It's foreign income. It is coming from another country. So we also need to see, depending on the double tax agreement, what is the agreement? How much are we going to tax you on that on that income? In some cases, you know what people do? They go hide their assets in another countries. Why? Because they know that here it's 27% or 28%, but if I go and put my assets there, they'll be taxed probably at 15%. Then I say the income comes back to South Africa, but I know that I was taxed at 15%. Then SARS comes back and say, no, there you were taxed at 15%. Here we do 27. Please pay us the difference between 27 and 15%, right? So that we know that we are all at par. So that most people, they don't go and hide their assets. So you know that, oh, okay, it's the same even if I go and if I don't go. So it's creating fairness, so that people don't hide their their assets, if I can use that word. Allow me to use that word. Okay, let's now go into the current text. Let's now go into the current text. Right, we want to see how do we calculate the current text. How do we calculate the current text? Okay, like we said, if you look on what I wrote on the left, we said this is where we are standing. Look at where we are standing. So if we are standing here, how are we going to start? We're going to say profit before tax. So we're going to say we are starting with our profit before tax. Remember what we said? We said that we have already calculated the profit before tax on the accounting side. And when we calculated this profit before tax on the accounting side, we now need to calculate taxation using that information. So we're now saying that we have the profit before tax. We've already calculated the profit before tax. Now let's now go to the taxation and find out that everything that we included above, when I say above, I'm referring to this. When I'm saying above, I'm referring to this. This revenue, cost of sales, other income, expenses, and expenses. Everything that we included above, is it allowed by SARS to be deducted or to be added? Does SARS allow all those income and all those expenses that we used to calculate profit before tax? And if SARS does not allow some of them, let's remove them or let's add them back. So our next step that we're going to go here is step where we say exempt differences. When we say exempt differences, we are saying that these are the expenses and income that SARS does not allow them to be taxed one and to be deducted two. SARS is saying, yes, you have incurred that expense, but no, you can't deduct that. And accounting is saying, no, it is an expense, deduct it. Right? So we'll be looking at these expenses and this income to say, okay, is this allowed or is this not allowed? And if we have such, what do we do? So in other words, let me just put a note here. I'm saying not allowed by SARS to be deducted or taxed. SARS will not allow you to remove that as an expenditure. SARS will not allow you to include that as income. So it forms part of what? Of our exempt differences. This forms part of our exempt differences. Okay. I'm looking at dividends. I'll be explaining each and every that we have. Where do we include it in accounting and why are we subtracting it or adding it, right? So dividends, we know that this is an income, but it is exempt according to section 10, 1K, if I'm not mistaken, of the Income Tax Act. So, but accounting says dividends are part of other income. So include them on other income. So in other words, in profit before tax, dividends have already been incorporated as income. But SARS says, no, we won't allow you to include that as income. Please remove them. So dividends, we come here, we say, yay, we're going to remove you. You're part of our exempt differences. As you are part of our exempt differences, please stay outside. We have foreign income. We know that we have a section for the foreign income where we're going to calculate how much tax are we expensed on those foreign income. So let's remove it as well. If we donate donations, if we donate goods, in accounting, it's an expense because we have done the donations, we've donated goods. It's an expense. It's called donations. It's an expense. But SARS come back and say, that expense that we have subtracted, do you have the section 18A certificate for it to be deducted? Where did you donate it to? Who did you give it out to? Was it a public benefit organization? What was it? Then SARS said, no, until you produce that certificate, we're not going to allow you to deduct that. Please add it back. Then you add it back. Are we together, guys? Are we following?
Yes.
Yes,
We are.
yes, there we are.
Yes.
Interesting. Accounting is nice. You realize after that, no, accounting is very, very nice. You know, if there's somebody who made you hate accounting, sorry. I'll try to make you fall in love with accounting again. All right. So we are saying donations. Yes, you have subtracted donations as expenses, but SARS is saying no. Until you give us the certificates that we allowed you to donate those goods, or we donated those goods for the benefit of who and who and who. Please do not deduct that expense. Please add it back. Then we add it back. Then we have assets that say you purchase this asset. Let's say it's a non-current asset. You purchase this asset, but we're not going to allow you to claim any capital allowances on this asset. Means that the asset is exempt. But accounting says, no, we're going to calculate depreciation on that asset. Then says the SARS says you are subtracting an expense that you calculated on an asset that we don't allow you to claim allowances. Let me go again. I'm saying that there are non-current assets that SARS is going to say admin building in this case, looking at an admin building. SARS say that, no, if you purchase an admin building, we're not going to allow you to claim any allowances on that admin building. But accounting says, yes, you can calculate depreciation on that asset. So that means in this case, we are not agreeing because accounting is subtracting something, taxation is subtracting nothing. Then if they come back and say, okay, included in those expenses, there's depreciation there that you subtracted on an asset that we don't allow you to calculate any allowances. Can you please add back that depreciation that you subtract? So we come here, we say depreciation on admin building. Depreciation on admin building. Then we say, please add it back. So the addition and the subtraction depends on how you initially treated that expense above there. If it was an income, it means that you need to subtract. If it was an expense, it means that you need to add it back. So you're doing the opposite so that we get to an amount that we all agree on. All right. Then.
Sorry. Is admin building the only asset that SARS does not allow us to exclude?
I haven't heard of any other non-current assets according to the Income Tax Act that SARS does not allow capital allowances. You know, they do. From my knowledge at this point, if there is any, I'll update you. But it is the admin building.
Okay, thank you.
What happens after you submitted the certificate of donation to SARS? Then SARS allows you to deduct it. So if there is a certificate, it means that it's not an exempt difference because you subtracted it, SARS subtracted it, both of you agree. It's not an exempt difference. As long as we agree. If we pay for insurance, SARS comes back and say, where's the invoice for insurance? Then we say, here's the invoice. We subtract insurance as an expense. We remove insurance as a deduction on the taxable income. It means that we are agreeing. There's no exempt difference. There's no temporal difference. We are agreeing it's 50,000. They're agreeing it's 50,000. No exempt difference. No temporal difference. We go on with our lives. So if you produce the certificate and say, okay, yes, the certificate, we actually donated to a company that you allowed us to donate and give us a certificate. Then you'll be like, oh, okay, no, it's fine. So now you can deduct it. So there is no difference. Right. So I remember when you did text 2601, You would calculate all your taxable income. Then at the end, that's where you put the donation. Then you say less donation. Section is it 18A donation. Then you subtract the donation. It means that now both of us are agreeing to say this is the expense that we have, and this is the deduction, the expenditure that we also have, you know. Okay. Then we have fines, penalties, interest. Let me say fines, penalties, interest on. Let me just rather say interest on illegal stuff. No? Okay. Is there anyone who works in the government? Maybe ESCOM, maybe
I'm
National
working
Treasury.
for the government. Here's a few government people.
Yes. Thank you. Right. So you know that there's something called the PFMA, right?
Yes.
Where they say this is how you do things, right? They say PFMA is for the departments, MFMA is for the municipality, right? They say here is how you do things. This is how you're supposed to do things. But for people being people, people are people. They'll be like, yeah, I know this is how we're supposed to do things, but no, we are not gonna do it that way. We're gonna do it this way. Then the auditors come and say, no, you did not do it the right way. You're going to incur fines, penalties, or you didn't pay actually SARS in time, then you charge the interest. Although the government departments don't pay tax. I'm just giving an example of where these things might come from. These are coming from not doing the right things. You're not following the right channels, to do stuff. So SARS is saying, why would we give you a deduction for you not doing the right thing? No, we cannot do that. And you know that payee, you're supposed to pay as a company, you're supposed to pay payee. When they pay you your salary, they deduct that payee, pay as you earn. You're supposed to pay that payee to SARS within 7 days after the month end. When you don't pay it, SARS comes back and starts charging you fines, penalties, interest. So SARS comes back and say, no, 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 no. You knew you were supposed to pay it within 7 days on the 7th, but you did not do it. So we're not going to allow you. But accounting says those are expenses. Please deduct them. Then SARS say, no, we're not going to allow you to deduct those. Those are things that you incurred on your wrongdoings. If you go back, the reason why I ask for governments is they say these are expenses that can be avoided by just doing the right thing. And they call them, I think, fruitless and wasteful expenditure, because they are saying that if you have done the right thing, you would have not incurred this expense. If you have followed the proper procedure, you have not have incurred this expense. If you have paid in time, you could not have incurred this expense. So this expense, you have actually incurred it for your own wrongdoings, for not following the proper channels, for not doing the correct things. So SARS says, no, we cannot incentivize you for doing the wrong thing. So please, add it back. Add it back. All right. Then we have the capital profit. We have capital profit. We have capital profit. In other words, you're selling the asset for more than its cost price. You're selling the asset for more than its cost price. Someone have an iPhone and they're writing on my screen. I don't know why. I won't be able to rub it, guys, if you write on my screen. So please do not write on the screen. Please do not write on the screen. I'm asking you not to do that. All right. So I'm saying capital profits, you're selling the asset for more than its cost price. Please do not confuse capital profits with, do not confuse capital profits with profit for the year. Do not confuse the two. Profit for the year, it's profit for the year. It's when you sell the asset for more than its what? Its carrying amount. So you sell the asset for more than its carrying amount. Capital profit, this is where you sell the asset at more than the price that you actually purchased it for. Not the carrying amount, not more than the carrying amount, not more than the carrying amount, right? So in other words, I'm trying to say, let's say, for example, you purchase a vehicle, and you paid 100,000 for this vehicle. That was the cost. You paid 100,000. Then you, after 2 years, will be like, okay, let me sell my asset. Let me sell my asset. Then you decide to sell the asset for 170,000. What does this mean? It means that you sold the asset at a price that is higher than its cost price, the price that is more than the price that you initially purchased the asset for. So this is what we call what? This is what we call capital profit. So the amount that is exempt here is going to say 170,000. It's not the 70,000 minus 100,000 times 20%. Then you come here, you subtract the capital profit. Why are we saying 20%? Because we know that at 80%, it will be taxed through capital gains. So the 20% is the one that is exempt. Then we deal with what? We deal with 80% when we go to our capital gains. Right. All right. Sure, we can continue. So we come here. Let's now go to our temporal differences. So here we're going to have our temporal differences. I'm going to explain more on the temporal differences when we are now talking about the deferred tax. When we're talking about the deferred tax. So we want the movement. So here I'm just going to write, but I'm not going to explain. Movement in temporal differences. Movement in temporal differences, right? I'm going to explain when we go to deferred tax. Then I'll come back and link it out to you to say, when it's like this, what do you do? When it's like this, what do we do? Right? So it's a movement in the temporal differences. Okay. Then after that, we get our taxable income. Get our taxable income, Then, after getting the taxable income, it's not always that it is an income. It's not always that it is an income. At times, it can be a loss. So we have those losses from the prior year that can come into the current year. SARS say that, okay, we have subtracted your income, we have subtracted your expenses from the income. But when we did this, we realized that naturally you have a negative. So for the sake of the business continuity, what are you going to do? Please carry over this loss to the next year. Before we tax you in next year, you're going to deduct these expenses, this loss that you incurred in the prior year. So this is what we call assessed losses. So we come here, we say assessed losses. Then we subtract. Then we have our taxable what? Profit. Then we say current tax at 27%, depending on what year you are preparing. 27% or 28%, or the percentage that is given. All right. Any questions before I move to deferred tax? Remember?
Sorry.
Yes.
For the assessed loss, will it be always given, or at times you'll be required to calculate it?
Assessed losses are given. Assessed losses are given.
Okay.
They will be given. Even in CTA, they'll be given. They'll be given. Do not worry about those ones. Okay.
Hello, good morning,
Are you
Washington.
clear? Yes.
Please go up the screen a little bit. I just want to see. Okay, thank you so much.
Okay. All right. Let's now go to deferred tax. Let's now go to deferred tax. Okay. We're talking about, remember we said income tax expense comprised of three things. Here we are doing the calculation. This is not the income tax note, or this is not the income tax expense. We are doing the calculation for the income tax expense. When we are done with the calculation, we're gonna now go and put it all together. All right. So we started with the calculation. All right. Let's now go to deferred tax. Yeah, guys, I want you to pay attention. I want you to pay attention. But yeah, no, it's fine. You guys have been paying attention. So to be unfair for me to say this, né? But I want you to pay attention when you're already paying the attention. All right. All right. So let's look at the deferred tax. Let's look at the deferred tax. Okay. All right. I'm going to give an example. Is the current tax not supposed to be deducted? Yes, it will be deducted. It will be deducted. But we are calculating that which is going to be deducted. But where is it going to be deducted? In the statement of what? In the statement of profit or loss under income tax expense. That's where you're gonna go and deduct it. But how did we get there? That's what we are doing. I don't know if if you understand me. Say, that's basically what we are doing to say. Let's calculate that is what is supposed to be deducted. When we are done, we go and put it together there, and we what? And we deduct it. All right. Deferred tax. Deferred tax. We are saying that this is the tax that is going to be paid in the future, recovered in the future, whichever way, depending on the asset. right? So when we say deferred in the deferred tax, we are saying that it's tax probably that we're going. When we say deferred tax liability, we are saying it's tax that we're going to pay in the future. We are anticipating that we're going to pay this tax in the future, but how so? Deferred tax asset is a tax that we're going to recover in the future, but how so? Right. So let's say, for example, guys, you purchased a motor vehicle. Motor vehicle. It's an asset. What is an asset, guys? What is an asset? What is an asset? What is an asset, guys? What is an asset?
It's a resource controlled by an entity as a result of past event, from which future economic benefit is expected to flow to the business.
That's correct. That's 100%. So we are saying it's a resource that is controlled by an entity. But there is a statement which says for which future economic benefits are expected to flow to the entity, right? So you need to know that when you purchase an asset of cost 500,000, when you go and say, I want an asset that is worth 500,000, or the carrying amount of this asset is 500,000, what are you saying? You are saying that I am going to have income of 500,000 or more from this asset. The moment you anticipate that you're not going to get 500,000 from this asset, this is where impairment comes in. The moment you anticipate that you're going to sell this asset that you have for less than 500,000, it means that the future economic benefits are no longer going up to 500,000. So, but this cost that you are incurring now, you are saying that future economic benefits that is going to flow to the entity, SARS is keeping an eye to say that, yeah, we saw you purchased an asset, we saw you, we were there. And you're expecting to get money from that asset for 500,000. But we'll be coming to that income that you're going to get at the rate of 27% each and every year that you're going to get that money. So when you purchase the asset of 500,000, SARS is saying, we're going to come, when you get that income in the future, we'll come and tax you that income at the rate of 27%. And when we tax you, this is future. So this is a tax that you're going to pay in the future with the fact that you just purchased an asset. By just purchasing an asset as a business, you are liable to pay tax that is going to come from this asset in the future. Then SARS comes and saying, you have actually purchased an asset. But before we tax you in the future at the rate of 27%, we're going to allow you to deduct something before we tax you. And what do we call this? We call this capital allowances. So here, we are now saying that on this asset, on the accounting, we're going to subtract what? Depreciation. Let's say, for example, 10 years. Then SARS say, no. We're going to give you allowances, yes. Because you actually incurred 500,000, but we won't give you for 10 years. Deduct all that amount in 5 years. So yes, we are going to allow you to subtract on the if on the income that you're going to get from that asset. We're going to allow you to deduct over 5 years, right? Then accounting says you're going to depreciate that asset over 10 years. So at the end of each and every year, we need to look back to say, what more are we expecting from the asset? And SARS will be keeping an eye and say, for now, we are still allowing you to subtract. What more can we get from you after subtracting this asset? So if I'm going to depreciate an asset over 10 years, I'm going to say 500,000 divided by 10, what do I get? 500,000 divided by 10?
50,000.
50,000.
50,000.
50,000.
50,000. So we are saying it's 10 years, right? So I'm going to say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Right. It's 10 years. So at the end of year 1, I'm going to say carrying amount, right? Let's put the carrying amount. At the end of year 1, I'm going to say 450,000, isn't it? That's the carrying amount because I'm subtracting 50,000 every year, right?
Mm.
Then end year 2, 400,000, 350,000, 300,000. Am I doing this correctly? Okay, let's see. 1, 2, 3, 4. 250,000, 200,000, 150,000, 100,000, 50,000, then 10, 0. Okay, so rather let me align my amounts to my numbers. So it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Then the asset is gone. This is accounting, right? The asset is gone. Then SARS comes and say, no. You're not going to calculate the tax carrying amount on that asset. We don't call it carrying amount yet. We're going to recognize the fact that you used the 500,000 to purchase the asset, yes. We're not going to call our deductions depreciation. We're going to call them capital allowances. But whatever is left, we're not going to call it carrying amount. We're going to call it tax base. So here SARS says, okay, no. Here's our tax base. So if I say 500,000 divided by 5, what do I get, guys?
100,000.
100,000, right? So it means that year 1, 2, 3, 4, 5. At the end of year 1, here I'm going to have 400,000, 300,000, 200,000, 100,000, then nothing is done, right? So guys, we are saying that in year
Sorry.
1, yes.
My apologies. The 400,000, this is after you have done what?
We have removed the capital allowances for year 1. Okay, let's do it this way. I'm gonna write in red. Year on depreciation. Okay, let me make it more brighter. Year on depreciation, we are saying 500,000 divided by 10, and we got 50,000. So each year we're subtracting 50,000 to get a carrying amount, right?
Correct.
On SARS, we are saying 500,000 divided by 5 years, and we got allowances of 100,000. So each year we're subtracting 100,000. You got it?
Yes, thank you.
Okay, yeah. So that's what we say we call the tax base. We don't call it the carrying amount, but we call it the tax base. So now, these guys now, they differ. in this treatment. Both of them, they're going to subtract 500,000, but the spread of it is not the same. It's different. So this is where
Sorry.
we create. Yes.
Sorry, can I just step in?
Yes.
Why is it that when SARS come, they limit the number of years that an asset can be depreciated? What method do they use? Why are they refusing to take 10 years? Why have they limited to 5 years?
All right. All right. What happens is that there is general binding rules in the Income Tax Act that tells us that's why I said this side, remember, it's an act. It's actually the law. So these years, they are stipulated in those laws. To say, because remember, here on accounting is subjective, right? Somebody can purchase a vehicle and put 10 years. Somebody, depending on how they're using it, somebody can put 2 years. Somebody can put 4 years. So now the question comes back, who is SARS going to follow? So SARS comes back and says, no. On all vehicles, probably it's 5 years. I put 5 years as an example. I'm not saying that's what's in the general binding rules. Because if you remember, our accounting policies allows us to adjust. Even the 10 years, after year 1, you see when we get to FAC 3702, after 2 years, we can actually change to say, we are changing the estimate. There's a topic that we say changing estimate. We're changing the estimate. We're no longer saying 10 years, but now we are reducing it because of how we are using it. Let's now put 5 years. So SARS is not going to follow you whilst you're doing that. They're just going to be like, you know what? No, you guys are going to do whatever you're doing. And you find out that firm 1 can purchase the same car and put 10 years. Firm 2 can purchase the same car and put 7 years. Firm 3 can purchase the same car and put 3 years. Accounting allows that.
So the problem is actually with us. There is no some sort of standard or rules that tells us, okay, for this asset, you can only depreciate it for a certain amount of years. We just come up with our own years, and the problem is on our side, not with SARS, because SARS keeps to a certain set of rules.
All right. Let me not say there is a problem. There's no problem. Let's start there. When it comes to accounting, right? Especially on the property, plant, and equipment, right? What happens with the depreciation? Remember, depreciation, it says it's wear and tear, right? So when we say wear and tear, we are actually reserving an amount so that we can purchase another asset at the end of its useful life, right? So what did our standards do? Standards says we cannot put everybody in the same blanket as if they are all using the same asset the same way. Someone can purchase a car and drive that car for 20 years, come back to work. Somebody who purchased the same car and start using it for Uber, can they depreciate the asset the same way? It cannot be.
No.
Because this one on Uber is forever on the road, is depreciating their asset. This asset is not. So when he goes to his books in the Uber, he cannot say, no, he's going to use the asset for 20 years. It's impossible. But can you also say that I can use my asset only for 2 years because I'm just starting my asset, I go park it on the car, I spend the whole day in the office, at night I come back, I park the car. I'm not going to say I'm going to use the asset only for 2 years. I'm going to use it probably for 10 years and I'll still have my asset and it still looks new, right? So that's what accounting is allowing us to do. It gives a room to say, you know what, these are the limits that you can have depending on how you are using the asset. We can allow you to determine as the management, right? As the board, when the board sits down, they know how they're going to use the assets. Some purchase their trucks to use them for delivery, take a lot, it's whatever on the road. Some, they just use it, whatever, when it is needed, So the management sits down and say, okay, guys, we are not really using these assets more frequently. So the depreciation that we're going to attribute to these assets let's reduce it or let's increase it, right? Accounting allows that. I don't know if you answered, ma'am, or I'm still with you.
Yes. No, you've answered. Thank you.
Yes. Then we jump to SARS. SARS says, no. This is an act. And Tina here, we want money. And with the fact that we want money, we want to run the country. So by running the country, we want money. But we know that you and I, you've incurred 500,000, right? And you're gonna come to us and show us a receipt that you have incurred actually 500,000. And we're going to agree with you. And with the fact that you incurred that, we are actually allowed to allow you to deduct as an expenditure that you incurred, but we're not going to allow you to deduct all of it in 1 year. We're going to give you 5 years and allow deducted 100,000, 100,000, 100,000, 100,000 for a period of 5 years. Right? So when you generate income from this asset, please remove 100,000 before we charge you 27%. That's what SARS is saying. Right?
Yeah.
So this is what, yes? Yes. Is there a question?
Yes, I've got one. Can you please repeat your last statement?
Okay. I'm saying, let's go back to SARS. Let's go back to SARS. I'm saying that you go and purchase a vehicle, right? Then you go to the board of directors. Then the board of directors say, no, with how we want to use this vehicle, let's depreciate it over a period of 10 years. Then we agree. Here's the accounting policy, vehicles, 10 years. We're done. Then we go and open the Income Tax Act and say, no, why did we purchase the vehicle? We purchased the vehicle so that we can generate income. We're going to do 1, 2, 3 things, deliveries, and also using this vehicle. Then SARS says, yes, we cannot just say you purchased a vehicle and you're going to generate income and just pay us. The cost that you used to purchase that asset, we're also going to allow you to deduct it when you get your income. But you're not going to deduct it in a period of 1 year. We're going to allow you to deduct it or to spread it over 5 years. So temporal differences comes in the moment accounting says 10 years and SARS says 5 years. Temporal differences kicks in. But if accounting says 5, SARS says 5, there's no temporal difference. Why? Because the depreciation is equal to the allowances. So we are doing the same thing. So there won't be a temporary difference. Why are we saying it's temporary? Because it's going to be recovered in the future. And I'm going to show you now how it's going to be recovered. All right. So what I'm saying now is that let's put a line on year 1. Let's put a line on year 1. On year 1, guys, if you look closely at the end of year 1, if you look closely at the end of year 1, we said that accounting is now saying this vehicle is now sitting in the books at what? At 450,000. And we defined an asset as a resource controlled of which economic benefits are expected to flow to the end. So now at the end of year 1, we are expecting 450,000 income to flow into the entity. But when we stand at the end of year 1, SARS say, on the 450,000 that you're going to get in the future, we are only going to allow you to deduct 400,000. So in the future,
I don't understand that part. Please say it again.
Let me start it again. Let me start it again. All right, let's start. I'm saying that we purchased an asset for 500,000, right? When we purchase the asset for 500,000, accounting says, yes, the cost price of this asset is 500,000. SARS says, yes, the cost price of this asset is 500,000. Let's highlight it here. Cost 500,000. Cost 500,000. You know, so both of them can now what? Can now start deducting, depreciating, whatever they want to do. You know. So what are we saying now? We said that accounting is going to depreciate this asset over, or rather, let me put it this way. Let me put it this way. Let me rub here and here. Let me say cost, depreciation, and carrying amount, right? And here I'm going to say cost, allowance, right? Then tax base. So here the cost was 500,000, depreciated 50,000, left 450,000. Here the cost was 500,000. We claimed allowances of 100,000. We left with 400,000, right? So here it's 450,000. You subtract 50,000, you know, going. So here it's 400,000. We subtracted 100,000, and we're left with 300,000, right? So yes, year 1, year 2, 3, 4, 5, 6, 7, 8, 9, 10. So yes, 1, 2, 3, 4. Sorry. 1, 2, 3, 4, and 5. Okay. The reason why I'm putting numbers is because I'm going to put a ruler so that we understand. Okay. Here's my line. Okay. So we are saying that the accounting guy is standing and say 500,000 minus depreciation. We have depreciated the asset for 50,000. In other words, he's trying to say we have used the asset for 50,000 and we are still left to use it for 450,000. And as we are still left to use it for 450,000, we are still expecting future economic benefits income of 450,000. That's what this 450,000 mean as an asset. We are expecting to generate 450,000 in the future, right? Then we go to SARS. What does the 400,000 mean? 400,000 on SARS. SARS says, yes, you have purchased your asset for 500,000, and I'm allowing you to spread over to remove from your income 100,000 each year. And in year 1, you have already subtracted 100,000 from your income. So in other words, I'm trying to say, when we're calculating, this is taxable income, right? And this is profit. Let's put it this way. This is profit. This is taxable income. Right. Then we are saying that we have sales, we have sold goods for 500,000. And SARS is saying, yeah, we're going to tax you on 500,000. Right? But when we're calculating profit, we don't subtract allowances, we subtract depreciation of 50,000. But when we're calculating taxable income, we don't subtract depreciation, we subtract allowances of 100,000. Okay, I think 500,000 is a bad example because it's the same amount that we're using. Let me say 700. 700. So what are we saying now? We are saying the taxable income is going to show 600,000, but the profit is going to show 650,000. You see where we are differing? We are saying that accounting have allowed us to subtract an expense of 50,000 and come to a profit of 650,000. But taxation, you've said, no, you can deduct the 100,000, the one that is highlighted in yellow. So your taxable income is actually 600,000. So there we differ. So what are we trying to do right now is that we have 650,000. We are trying to go back to 600,000. This whole activity that we are doing. Because remember, we are not doing tax, we are doing accounting. So we are given 650,000, which is our profit before tax, and we're trying to play with it so that we go back to 600,000. But now we're trying to figure out how did we get to 650 and how did they get to 600,000? We did not agree on this. That's why we got there. That's why we say this is a temporal difference, right? So this is where we are now. So let me go back to what I was explaining. I'm saying, guys, that when we are standing at the year end, 450,000 is the carrying amount. We are saying that okay, I was reading the charts. We are saying that we are expecting economic benefits of 450,000 at the end of year one. But SARS says that no, in that future economic benefits that you are expecting for 450,000, we are only going to allow you to deduct 400,000. So in the future, where you're going to make your profit or where you're going to get your income of 450,000, I'm only going to allow you to deduct 400,000. So what does this mean, guys? You have income in the future of 450,000 that you're expecting to get, but your deductions are only 400,000. What does it mean?
You'll have an excess of 50,000.
You have an excess of 50,000. So SARS comes back and say, you're going to get future income of 450,000. Yes, we are looking at you. But from that 450,000, we're only going to allow you to deduct 400,000. So it means that in the future, you're going to get an additional 50,000 that we're not going to deduct. And we want our tax on that 50,000. But where is this tax? It's in the future. So this is where we call deferred tax liability. Why? Because as I'm standing now, I'm looking to say I'm going to make additional 50,000 in the future. And in that additional 50,000 in the future, SARS will not allow me to deduct anything. And I'll be liable to pay tax on that at the rate of 27%. So that's what we call deferred tax liability. Are we together there, guys? I know this is a bit complex. We can spend as much time as we need for here so
No,
that we
sorry,
understand. Yes.
sorry, can you please repeat? In terms of the difference of 50,000, you're saying that the 450 is what we still expect to have as an income to receive to generate, right?
Mm-hmm.
And then SARS is going to deduct the deductions that we're still going to incur are 400,000. Can you please re-explain that part to me? Actually, the last note that you made that led to the difference of 50,000.
All right. I'm saying that when we look at an asset in the cost price of an asset in taxation, we are actually determining the allowances, how much from our income. And most people, they always try to maximize that cost so that they can have more allowances, so they can pay less tax, right? But when we are looking at a cost price of an asset, we are saying that you cannot go and pay something for 500,000 knowing exactly you cannot get back your money. The reason why people start business is because they want back their money, isn't it? But do they get their money today? No, they get it in the future. Right? When you are investing, are you getting your money today? No, you're getting it in the future. So SARS comes back and say, in the future, you're owing us tax because you're going to get 1, 2, 3 things. We want our tax there. Right? So SARS now comes back and say, yes, you have purchased a vehicle. Let's look how you're going to depreciate your vehicle. How are you going to use your vehicle? Then you say, no, I'm going to use my vehicle in a period of 10 years. When I'm using my vehicle in a period of 10 years, I'm going to say, 500,000 divided by 10, I get 50,000 every year. So at year one, I'm going to say 500,000 minus 50,000, I'm going to get 450,000. So at the end of year one, I'm still expecting, let me use the word money, I'm still expecting more money or more income of 450,000 from this asset that is going to come from the future. Then SARS comes and say, okay, no, it's fine. You're going to get it in the future, your 450,000. But this year, we have allowed you to deduct 100,000 because we took your cost price of 500,000. We said we are spreading it over 5 years, so we are deducting 100,000 every year. So what are we going to do? We are going to subtract 100,000, then we'll be left with 400,000. So now you need to know the definition of these two amounts that we have. Just hold on for me. 450,000. What is the difference between this carrying amount of 450,000 and the tax base of 400,000? The carrying amount is saying, this is the future I'm going to get in the future. This is the income, sorry, I'm going to get in the future. That's the definition of an asset. We control this asset of which future economic benefits are expected, right? So this is the income that I'm going to get in the future. Then SARS comes and say, yes, we know you're going to get future income in the future, but in that income in the future, we are only going to allow you to remove 400,000 as a deduction. So we're going to get income. We're going to get income, 450,000 from the asset, and we're going to get deductions of 400,000 from SARS. Then we'll be left with what? 50,000. So now SARS looks in the future now and say, no, yeah. There's income that you're going to make in the future of 450,000. And we're only going to allow you to deduct 400,000. So you're going to have an excess in the future of 50,000. And in that excess of 50,000, please pay us our tax. You're going to pay us the tax on that what? On that 50,000.
So
is it
you
making sense?
you pay that tax. Sorry.
Come
So you
again?
pay that tax now. So
No,
you're
you
paying
don't pay
that
it
tax
now.
for 50,000 now.
No, you're not paying it now. I'm going to explain what's going to happen. You pay it. It's tax that is deferred in the future. It's not now. Apologies if I say it now.
So if I may ask, with the 400,000 that SARS is going to deduct, is it SARS taking that money or you are saving that money and then the 50,000 is the one that you are going to pay tax on? I think there is a bit of confusion on my side onto that statement.
Okay, repeat again.
With the 400,000 that SARS is going to deduct, is it the money that you are going as a business person save and leave 50,000 for SARS to tax, or what is this 400,000 SARS is going to do with?
Okay.
I'm not sure if you're getting my question. Yeah.
Okay, let me try to answer, and then you tell me if I answered you correctly or if I got it correctly. All right. I think from my understanding, you're trying to understand what is this 400,000 that is coming from SARS? What is the embedded, or what is the effect of this 400,000 in our accounting, or is it money that we are saving on our side? Is the 400,000 is opposed to the 450,000, right? You know.
All right.
Okay. So I want to give you an example first. I want to give you an example. When you are calculating your, we all pay every year, isn't it? You know, when you are calculating your employee tax, there's a section where they say income, and there's a section where they say deductions, isn't it?
Yes.
Are you still with me, Lucia?
Yes, I'm
So
with you.
these deductions, you are saying that when you have actually worked for your money, and SARS is now saying no. Before we multiply with our 18%, or before we put you in any bracket, we're going to subtract these deductions. And I'm sure those deductions include something like medical aid or pension funds and all that type of stuff, right? You know,
Yes.
because SARS is saying we're allowing you to have a benefit before we tax you, because you are incurring this cost, right? Right. So can I say you are saving that money when you pay for your medical aid, and SARS comes and say, no, when I have actually earned 50,000 this year, this month, I mean, and you paid for medical aid 5,000. So before we calculate your payee, let's remove 45,000. Let's remove 5,000. Can I say you have saved 5,000?
No.
No, you did not save. SARS is giving you a benefit because of the cost that you have incurred, right? Because if they tax you on 50,000, your tax is going to be higher. Because if I say 50,000 times 10%, I'll get 5,000, right? But if I say 45,000 times 10%, I'll get what? 4.5. So it means that your tax has been lowered by the fact that you're paying what? You're paying medical aid.
The medical
So
aid.
that's what SARS is doing, right? SARS is encouraging people to go and say what? Purchase assets and do businesses. Even for now, SARS is encouraging people to do the green energy, because they say we're not going to allow you to deduct the whole 500,000. You're actually going to deduct 750,000 more than what you have actually incurred. You know, can we say you're saving? Yes, you're saving at a certain extent, but is this the cost that you have actually incurred? So SARS is now saying that no, before we tax you, we are acknowledging that we have incurred this cost. So by incurring this cost, we are giving you a benefit by deducting from your income before we tax you. I don't know if I'm making sense though.
You are definitely making sense.
You know, so SARS is now saying no. At first, day one, we are all deducting 500,000, 500,000, yes. The temporal difference comes when we don't deduct the same amount over the years. Because SARS is now saying that, okay, yes, I'm going to allow you to remove 500,000. Your income, let's say, for example, your income is 600,000. Then SARS say, no, yes, you have generated 600,000 from your business. But before we say times 27%, let's remove 100,000. So you'll be left with 500,000. So now, can you allow us to tax you on 500,000 since we gave you a benefit of 100,000? So what the 400,000 mean is that SARS is saying, I'm still have 4 more years allowing you to deduct 100,000, 100,000, 100,000, 100,000. Are we together, Alicia?
Yes.
So
yes.
with the 400,000 means that, yes.
You're saying the 5,000, the medical aid will lower the amount of tax that you're supposed to pay
Yebo?
if you direct it.
Yes, we're giving an example.
So okay, most companies forces people to have medical aid. Is it because they want their taxes to be lowered or what? Is that the reason?
Okay. I think this one I will just say side note, ne? I'll say side note. I just want to answer you so that you're satisfied on that one, right? Side note, what happens is that when companies forces you to have medical aid, it's not like they want to lower their taxes, but it depends on the company policy. From the company that I work for, it happened that one day, on our way to an audit, people got into an accident, and the ambulance got there, they took the director and left everybody else, you know, only to realize that they took the director because the director had medical aid and everybody else did not medical aid. Imagine how they felt at back when they came back and realized that no, everybody else was left, because they say, oh, do you have medical aid? No, they didn't consider them, and then they left. You know, so because of that, our company also ended up creating that policy and say, no, everybody medical aid in case that happens. So that had nothing, that decision had nothing to do with tax, but it had more to do with the company policy. I don't know if it makes sense there.
Okay,
I was
thank
just,
you.
that's why I said side note.
No,
So in
yeah,
this
it
one, I was
does.
just giving an example to say when SARS say this is a deduction, that deduction will end up actually paying less tax. You know, so when SARS gives us a benefit and SARS gives us a deduction, this is actually allowing us to pay tax, because if I incur income, if I got income of 1 million and SARS say no, before you calculate our tax, remove 100,000. It means now I'm left with 900,000. So now I'll be paying tax of 900,000, which is lower than 1 million. So I'll pay less tax in this case. You know? So SARS is now saying no, we are giving you the benefit because you incurred your money 500,000, so we're going to allow you to deduct it. You know, so what I was saying is that the 450,000 that is written carrying amount, the definition of it is saying I'm gonna get 450,000 in the future as income. The 400,000 that is in tax base means that I am going to allow you to deduct in your future income 400,000. Right. Let's go to year 2. I just want to give you an example. Or rather, let's go to year 3. Year 3 is here, right? This is year 3. Something I did not put this in line. Eh? 400,000, 300,000. Yes, this is year 2 now. Okay. Carrying amount is saying that we're going to get future economic benefits of 400,000. SARS is saying we are left now with 300,000 to deduct in the future, because year 1 we removed 100, year 2 we removed 100, so now we are left with 300. So in the 400,000 that you're going to make in the future, we are going to deduct 300,000 because that's what we are left with. So when now you have an additional 100,000 that you're going to make in the future of an excess that you're going to pay as tax on. Then now we get to year 5. This is where things becomes interesting. Where SARS is done. SARS say no. We've actually allowed you to deduct 500,000 and on all your income. So any income that you're going to get in the future. So now we are done deducting everything. We are done deducting everything. So any income that you're going to get in the future from year 6, you're going to pay us tax on, because SARS is now saying the tax base is now 0. There's nothing more for us to deduct. So any income that you get there, you're going to pay us tax. So what does this mean now? When I'm standing on year 1, it means that there is going to be a time in the future where SARS is going to say, I'm done. I'm going to get, then I get income and SARS does not deduct anything. It means that I'll be liable to pay more tax in the future. That's what we're calling deferred tax liability. Let's get an example where we finish first before SARS. Let's see what happens. All right, let's see what happens if we finish first before SARS. Let's say, for example, we purchase okay, I usually don't want to wrap. Let me just translate this. Because here we are saying that The carrying amount of an asset is greater than its tax base. That's why we are having a liability. So guys, you need to write that down. We just prove now that the carrying amount of an asset is greater than its tax base. It's deferred tax liability. Everything else becomes the opposite. Okay. So now,
may you please repeat that quickly?
Okay, I'll write it down. Carrying amount greater than tax base, deferred tax liability. That's what we're just proving right now. When the carrying amount was greater than its tax base, we say that there's going to be a liability in the future, right? Now, let's say, for example,
Wellington, sorry, Washington.
Yes.
Is it because the carrying amount it's now 250,000 and the tax base is 0 from
That's
the fifth
correct.
year?
That's correct. So you look at it at the end of each and every year. At the end of year 1 was 450. The tax base was 400. So carrying amount is still greater than the tax base. So you look at it at the end of each and every year. All right. So now I want to give an example, but in this example, let's finish first the depreciation before the what? Before the allowances. So let's bring back our allowances to 5 years. Our allowances is 5 years. We purchased furniture. And we purchased this furniture for 100,000. Allowances 5 years. Then this furniture is depreciated over 2 years. Right? So what does this mean on the carrying amount? It means that year 1 is going to be 100,000 minus what?
Isn't it 50,000?
100 divided by 2, that's 50,000. So it's going to be 50,000. So here we have a carrying amount of 50,000. Then year 2, I'm going to say 50,000 minus 50,000. Then I get 0. It's done. 2 years, it's done. Then let's go to tax base. Tax base, we say 100,000 divided by 5 years. What do we get?
20,000.
So you have year 1, year 2, year 3, year 4, year 5. So I'm going to say 100,000 minus 20,000. I'm going to get 80,000. Want to know what's the definition of this? Then 60,000, right? Then 40,000, right? Then 20,000, right? Then 0. So here allowances, we are saying our allowances is 100,000 divided by 5. So which means it's 20,000 per year. Our depreciation, we are saying 100,000 divided by 2, we get 50,000 per year. Right. Then we separated the two. Okay. Right. Then now, let's go to the end of year 1. Year 1 is here. The tax base at the end of year 1, it's 50,000. It's 80,000. But the carrying amount is 50,000. So now we want to know, what does this mean? And how is this happening? You know, so we are now saying that, let's go back to our definitions again. We are now saying that I'm going to get future economic benefits of 50,000. Right? But in that 50,000, SARS will allow me to deduct how much? 80,000. So what does this mean? It means that SARS will allow me to deduct more than what I'm going to get in the future. So who's going to pay who in the future here?
SARS will pay us.
SARS will pay us. In other words, I'm going to get a more benefit in the future because SARS will keep on deducting. Whilst my asset is gone. At the end of year 2, I no longer have an asset. But year 3, year 4, year 5, SARS will keep on deducting. So I have a benefit in the future. SARS will keep on what? Deducting. So this is deferred tax what? Asset. Because I'm expecting to get more from SARS than it is today. I don't know if that makes sense, guys.
It does, sir.
It does.
All right. Okay. Because of our time. Okay. I wanted to go through the list of the carrying amounts where temporal differences can arise. Here we just looked at vehicles and we just looked at furniture and obviously buildings, obviously land, and all other assets. We also want to go through other examples and explaining each and every example. What does it mean? And why do we have a carrying amount here and why we don't have here? Because we have something like prepaid expenses, we have allowances for credit losses, we have accruals, we have provisions. Why are we having a temporal difference and what does it arise from? What I usually do when we start a class is that I usually don't want us, when we are doing questions, to be an act of you cramming because I said so. You need to understand so that you are able to apply your own mind. So if you understand, yes.
Before we get into that, but the part where we say temporary differences or the movement in temporary differences, with the calculations that we did now, the 50,000, how much are we going to put under it? Are we going to put 50,000 or are we going to say 50 times 27%?
All right, just hold on. What happens, ma'am, is that when we say movement in temporal difference, we are in 2024, right? We're going to have 2 years whenever we are calculating this, 2022, and we're going to have 2023, right? We're going to have a table that shows carrying amount, tax base, temporal difference, and the deferred tax. Carrying amount, tax base, temporal difference, and deferred tax, right? So you calculate this for 2 years, right? That's what we're gonna start doing in our next class, right? Right. So in this case, let's look at our vehicle. If we go back to our vehicle, year 1, the carrying amount was 450,000. The tax base was 400,000. The temporal difference was 50,000. So if I say 50,000 times 27%, how much would be my deferred tax? It's 13,000.
13,500.
So on our deferred tax, we have asset, we have a liability. Guys, I'm just doing this to answer her. We're gonna go through it again together. We'll just go through it again together. Then if you go to end of year 2, so I'm saying this is 2022, this is 2023, right? Year 2, carrying amount is now 400,000. Tax base is now 300,000. So what do? We come here to 2023. We say vehicle 400,000, tax base 300,000. Then we say temporal difference, you get what? 100,000, right?
100,000.
100,000. 100,000 times 27%, you get 27,000.
27,000.
These are liabilities, right? So when we will say movement in temporal difference, We go to the temporary difference column. This one. We say 100,000. Sorry. We say 100,000 minus 50,000. How much do we get?
50,000.
This 50,000 is positive, right?
Yes.
Yeah.
Then you go back. There's an example that we gave. Where is it? The 650 and 50,000. Did I rub it? You see why I don't rub now. Okay, let me just put it quickly. There was a time where I say taxable income and profit. Where I say taxable income and profit, right? And we said that if I have my income of 700,000, what does, if I have depreciation is going to allow me to subtract 50,000, but allowances will make me subtract 100,000. So here I'm going to have taxable income of 600, but here I'm going to have taxable income of 650,000. So now, if we don't have anything else, this is where the 50,000 comes in. We come here, we say movement in temporary difference. It's positive here. You come, you subtract here 50,000. Then it becomes 600,000. Then now we agree. That's what we're doing. Do you understand what I'm saying? But it's an exercise that we're going to do in our next class. We'll start here with on the deferred tax. We list it out, and we do the example that that I brought in there. So basically here, when we say movement in temporal difference, here is positive, means that here you're gonna come and say 50,000 minus. Are we together?
Yes, I understand.
Yes.
Okay. Yes, no, we'll look at it, don't worry. We'll look at it together, and we will make sure that you understand. All right, guys, because of our time, I know, guys, I know deferred tax is not an easy topic. Even those who are doing, even the CAs, chartered accountants, if you just go to one and say, can you explain to me deferred tax? How does it work? You know, they will tell you they will need to go and study first and come back. It's not an easy topic. I'm not saying that they don't know, but I'm saying it's not an easy topic that just comes into your head and you understand there and there. Oh, I understand. It's good to go. No. That would be a lie. It's a topic that we would also do in class, as we are doing it in class. You also go through your tutorial later and see, okay, what is this deferred tax? Maybe the definitions. Then when we come back, you have your questions to ask, then we go through it together. The more questions that we're gonna do, the more you're going to have a better understanding. Like what I said at the beginning, just give me a few minutes for the recording to process. Once it's processed, I'll send the recording in the group. All right, guys, I'll see you next week, same time. Then when we are done with our income tax, then we talk, then we separate. Other than that, I'll see you in class next week, 10 o'clock to 12 o'clock, same time. Thank you very much, guys.
Before you leave Washington,
yes.
what other modules do you offer classes for?
Okay, we offer FAC, auditing, tax, MAC, but me, I'm only responsible for FAC. Tinashe will do auditing with you. and the other guys who do tax and MAC. Me, I'm only responsible for FAC.
Thank you.
That's why when you hear me sometimes talking about tax, I don't really say the whole sentence, because I say no, I'll say the other thing. And when you guys go to tax class and be like, Washington said this, no, we know. Yes, the timetable, I'm gonna share it again after the class, so you guys can see what times are the other modules. Right.
Washington?
Yes.
Hi, very good question. I just want to know the 50,000 on the where you compared, you said it's positive. Is that because the movement has gone from 50,000 in year 1 to 100,000 in year 2? That's why it's positive.
That's correct.
Because the way I'm just looking at direction. So you've counted it from year 2, the movement from year 1 to year 2 has increased by 50,000. That's why you're saying it's positive.
That's correct. So sometimes you'll see that when we have more temporal differences, the year 1 can actually be more than the year 2. So the difference sometimes will be negative. You know, then you go on temporal difference, then you add, you do the opposite. We'll see when we are doing it in class. So when we're doing a question to say, okay, now we have more than one asset. How do I deal with the temporal difference? How do I deal with this and this and this? You know, so we'll discuss about it in the next class.